how you can put a plan in place and what it should look like. We're going to talk about a lot of topics that address this. So I hope this is helpful. I have distributed a one-page, kind of a one-page sheet that shows you the work that we do with business owners. This would fall under the business continuation topic from our perspective. But business continuation is a big topic, and it covers a lot of areas. So we're going to touch on most of those today. Okay. There we go. We have to have a disclosure. We're not lawyers. We're not accountants, and you should speak to your lawyers and accountants when you engage a topic like this. Why do businesses fail after the first generation? I want to pose that as a question. Does anybody have an idea why a business might fail after the first generation? Anybody at all?
The culture could change.
Certainly.
Most businesses are small businesses, and the person in charge it's their business. Once they're gone, who knows?
Who knows what happens?
Right. Might get better, might get worse.
Absolutely. Anything else? Well, we have some ideas about this, but here's some statistics. 30% of businesses make it through the second generation of ownership. Less than a third. 12% make it through the third generation of ownership, and then 3% make it through the fourth generation of ownership. The fact is this: business owners have plans in place for exiting their businesses, either voluntarily, as we mentioned, or involuntary. 41% have a documented succession plan, a written documented succession plan. Oh, sorry. I'm so sorry. This is going on. For some reason, this is going in the direction. Oh, I'm sorry. Here we go. Okay. Thank you. I'm so sorry. 41% have a documented succession plan. 60%, and we see this so frequently. This, to me, is the most overlooked issue for businesses, having a buy-sell agreement in place. 100% will exit their business, planned or otherwise. What are some common excuses that business owners have for not putting a plan in place? You know, one is, I don't feel like I need to think about these issues yet. Another would be, I'm too busy with the day-to-day management of the business. I just don't have time. I like to say in this regard, and this is probably the most heard excuse, but I like to say in this regard that most business owners are so busy with their business, they only spend time working in their business. They don't take the time to work on their business, which means really planning for the future. I don't have extra money to put towards addressing these issues. I don't have the budget. I would not know where to go for help. And lastly, it is an uncomfortable conversation with my family and or my business partner. Continuing the question, why do businesses fail after the first generation? For many, the process of planning has begun, but few have seen it through to its completion. So about 45% have identified the steps that need to be taken. About 35% have calculated how much money is needed. About 32% have hired or trained. About 20% have obtained a business valuation, and we'll talk more about this in just a moment. And about, 15% have actually created a written succession plan. By the way, I meant to mention this earlier. You're going to see many of the statistics that we're showing come from, and by the way, this is a MassMutual presentation. I think it's a wonderful presentation that we have borrowed from MassMutual, but you're going to see that many of the statistics here come from a 2015 study that MassMutual did on business owner perspectives. And a lot of the data also comes from DEI, which is the Business Enterprise Institute, does a lot of work in the exit planning phase. So what is succession planning? We have borrowed this definition for succession planning from Entrepreneur magazine. But now Entrepreneur magazine is really targeted to entrepreneurs, many of whom would be really emerging companies that hope to go public one day. And so the succession plan that Entrepreneur came up with is the process of planning for the day a business owner decides to step down from their leadership role in the business. Now, we would like to expand on that, especially for private, closely held businesses, to say that really succession planning is the process of developing a written plan for the day a business owner decides to or is forced to step down from their leadership or ownership role in the business due to a voluntary or involuntary departure. So this is our definition of succession planning. So what goes into a good succession plan? Really, these goals are the ones you need to think about. What are my goals as a business owner? What are my goals for retirement? What are my goals for really liquidity? So what are my goals as a business owner? Who will the successor be? Will it be a family member? Will it be a inside employee, a key employee, or perhaps key employees in the business? Will it be an outside buyer? And we're going to look at the 6 options for exiting your business in just a moment. Ownership. How would the ownership be structured? Management. Is there management in place that may not become owners but are important to the operation of the business? And how do you prepare them for a transition? Transfer. What is the method of transfer? Of all the options available, which one are we going to target? And then the finances. What needs to be devoted to preparing for a successful exit? And what do I need to do personally from a legacy and or estate planning standpoint upon the exit from our business? So what we believe goes into a good succession plan is addressing all of these issues, and that the plan be documented, in other words, written, and that it be communicated really with all the parties that have an interest in this. Successors, obviously. Key employees, certainly. Family. Communicate the plan to all that have an interest in successful. So what goes into a good succession plan? These are the golden rules of succession planning. First of all, know all of the options for exiting the business and the ramifications of each. We're going to look at that in just a moment. Number 2, know the true value of the business and have it documented. This is actually an area that our firm does for our clients and for other businesses that are interested, is a business valuation. We stop short of providing a certified valuation, which can be very expensive. Has anyone used a certified business appraiser to know the value of their business? Okay. You know, and yet this can cost $10, $20, $30, $40, $60,000 for a certified valuation. You need a certified valuation if there's a chance that you're going to be defending the value of the business in a court of law. So if you're being sued, if you're getting divorced, have an ESOP, there are instances where you must have a certified valuation. But anything short of that, and in fact, for just planning for the future, you don't need a certified valuation. We are able to provide a valuation that stops short of being certified, but it does not stop short of being accurate and valid. So that's something we can talk about. Select and prepare the right successor. Communicate to everyone. We'll talk more about that. Put the plan in writing and fund it properly. We often do see businesses that have buy-sell agreements, but they're just not funded properly. And so it leaves the business still exposed. You know, they know what they're supposed to do, but are they able to do it? Do they have the funding? And then review the plan at least every 3 years and update it as needed. But things do change. Things will change, and you should review the plan at least every 3 years. So let's talk about the 6 ways to exit a business. So the rule number 1 is know your options. These are the 6 ways to exit the business. Number 1 is go public. Now, we're going to include in Go Public, selling to private equity or venture capital or some of those as well, because it's very similar, but Go Public is the first option. The second option is employee stock ownership plan. Are there any ESOP companies in the room? Okay. Has anyone looked at an ESOP as an exit strategy? Okay. We could spend the next several hours talking about ESOPs. We're not going to do that, but we are going to touch on ESOPs as an option. And Doug mentioned this. We've had several clients that have done ESOPs, and they are becoming more.
They're, for construction companies, they tend to be one of the handful of solutions because they're tax efficient,
Yeah.
and there's not as liquid a market for construction companies as other businesses that have recurring revenues. So there's not a big incentive to sell it to a third party because the price you're going to get doesn't necessarily reflect the economic value of the business.
Absolutely. So, and there are advantages. There are advantages and disadvantages to all of these, but especially the ESOP. So we'll talk briefly about that. You can gift to a family member, give the business to your kids, okay? You can sell to an outside buyer. So often when we meet and talk with business owners, their image is, well, one day I'm just going to sell this business. But the reality of that happening is fewer than you might want to think. A management or inside buyout. I'm going to sell this to my key employees, some of whom might be family members. So you don't have to gift to a family member. Maybe you sell the business to a family member. And then lastly, and least favorably, is liquidate. I'm just going to turn off the lights, shut the doors, sell what I have, pay off what I owe, and walk away with whatever's left. Not the best option. In fact, the worst option. So let's talk about these one by one. First of all, go public. What are the pros of going public? First of all, it can bring immediate wealth to the selling owners. We also see and would include in this category selling part of the business, say maybe 80% of the business, to new equity partners, whether that's private equity or venture capital or whatever. So the pro is that you generally get a pretty good source of wealth by going public. Really, the con is the owner gives up control and no longer has a, quote, voice in the business. Perhaps he stays on as a CEO, but who actually now controls the business? The board of directors, correct? So the owner gives up control. A risk is that owners may end up buying shares back later at a much higher price. We also all saw the tweet from Elon Musk who said he had raised the money to take the company private again. You remember that? That can come at a much higher price than initially. So going public is certainly one option, the first option. The second is the employee stock ownership plan. The pros of this is it can provide nice tax advantages. One tax advantage of an ESOP is there is a mechanism by which the seller of a company to an ESOP can get deferral of capital gains until death. What happens at death? You get a step up in basis, which means there's no capital gain. So literally with an ESOP, there is a way to avoid paying capital gains. That's a huge advantage of an ESOP. Another big advantage of an ESOP is that typically an ESOP is going to be financed. And so you go to a bank, you borrow the money. And so it's really a wonderful way from a tax standpoint to get the funds available to buy out the business. So it can provide nice tax advantages. The cons of an ESOP are that it may be expensive and it's complicated to set up and administer. So an ESOP is not for everybody. It is expensive. I mentioned the business valuation. If you have an ESOP, you have to have a business valuation done each and every year. Basically because the employee stock ownership plan is a defined contribution qualified plan. And so basically the employees will receive grants of contributions to a defined contribution retirement plan, the investment of which is primarily the stock sponsoring company. So you have to have a business valuation every year, so you know what to report to the employees as the business value.
And there's a trustee appointed who looks out for the
Yes.
retirement plan too, so it's a real arm's length situation so that you can't game it. One of the other tax advantages is it becomes a tax-free entity when you're 100% ESOP.
Well, if you are an S Corp ESOP.
Right.
Yeah, thank you. That's a great point. Yes, S Corp ESOPs are basically tax-free entities because the tax is not paid until an employee leaves the company and receives a distribution and basically sells their stock back to the ESOP. Then that's a taxable event. But until then, it's a tax-free entity.
And so if there's debt associated with the buyout, the principal and interest are deductible.
That's correct.
But one of the big tax.
Another big, yeah, and I didn't go that far in my description. That's exactly right. The risk, there are only 12,000 ESOPs in the U.S. This was a 2014 study, so I'm guessing that's a little bit out of date. They're probably now, 14,000 ESOPs in the U.S., but it's not a huge number. And an ESOP does require, I think this is low, but it does require $2 to $3 million in revenues, and it requires 20 plus employees. So an ESOP is not for everybody, but if you explore this and find it is for you, there can be some tremendous advantages. One of the issues of an ESOP is yes, sir.
Is that a regulatory requirement, or is that just a practical requirement that's not efficient?
Yeah.
Prior to those.
Right. Yeah. It's not regulatory. It is more a matter of efficiency. It just doesn't work though for smaller companies.
Unless the margins were really high, you wouldn't be able to do it at this low size, just due to the friction costs of having the audit done and the appraisal done and the cost of administering the plan. So what would you say annually on a $50 million company?
Well, I
80,000. I mean, that's a significant amount of money.
It is a significant amount of money, and I would put it much higher than the 2 to 3 million.
Right. I mean, you'd have to have like 90% margins.
Yeah, sure. Number 3 is a gift to a family member. A pros of that is it creates a family legacy. The family continues to run the business. The cons is it's a non-cash transaction. In other words, it's not going to put money in my pocket if I gift it to a family member. And the risk is the owners never truly exit the business due to continued financial dependence because if they don't receive cash for the business, they still need to retire at some point, and who's going to help pay for that? Probably the business, so you never truly exit. Sell to an outside buyer. The pros, you can get the most dollars at the point of sale. And particularly if you can find a strategic buyer who really needs your business for whatever reason. We were working with a business just recently who has a huge disadvantage, and that is that 95% of their business comes from one customer. That could also be an advantage if they found a strategic buyer who wants to acquire that business. So, it's got kind of a push and pull, but get the most dollars at point of sale. The cons, you may be forced to share key elements of the business with the competition, which leads to the risk, which is after analyzing the business and uncovering potential trade secrets, the buyer backs out. So that's a risk. If you're selling to a competitor, you're really putting yourself out there at risk selling to an outside buyer. Number 5 is a management or inside buyout. The pros are the buyer knows the business. The buyer knows the business and is someone the owner already trusts. It's probably a hand-picked successor that is very responsible already for the success of the business. So they know the business and the owner trusts them. The con to this is the buyer typically has little cash at closing, and so preparing to sell to an inside buyer does require planning in terms of funding. Where is the funding coming from? Well, we've got some good ideas there. I'm not going to get into the details today. We have some good ideas on how you can structure that, where the seller actually funds basically the down payment of the business, but actually receives that back at the time of purchase. So that's kind of a cool thing. And often, and most of the time, in an inside sale, it's going to be an installment sale. So you're going to be paid over time. And then the future success of the business is dependent on your being, is dependent You're dependent on the future success of the business for funds. The risk here is that sometimes good employees take bad entrepreneurs. Liquidate. I'm not going to get into a lot of detail here, but if you're in a situation where you are forced to liquidate, or if you think that might be a possibility, you need to ask yourself the 7 questions. Would a spouse or child own or control the stock? Would they be liable for your debts? Do they lack executive experience? Would sales fall? Would profits decline? Would key employees consider leaving? Would clients think about leaving? So liquidation is absolutely not the preferred way to go. But it is the solution you see at the bottom about 40% of the time. Yet only 13% of business owners say it's their desired plan. So there's a big disconnect there. Failing to plan, planning fails. Number 2, know the true value of your business. Over half of business owners say they've had their business valued, but not really. Because most business owners who have valued their business have done so themselves, okay? But if you ask business owners, who would let you know the fair market value of their business, 42% would say my CPA or accounting firm would do it, 32% say I or my partners would do it, and 27% would use a business valuation service company. Business owners over or undervalue their businesses by as much as 59%. There's a big disconnect with knowing the true value of your business. Now, why would you value your business? Why would you get a business valuation? Really, it breaks down into wants or needs. I want it because I want to have another measure of business health or success. I want to know if the business has value in the marketplace. Could I sell it? I want to prepare the business for sale and maybe grow the business so that I get more money to sell. I want to know if it's sufficient to fund my retirement. You might need to know for these reasons. Number 1, maybe there are multiple owners and you need to properly fund your buy-sell agreement. We see so many issues with buy-sell agreements, particularly as it relates to the valuation of the company. We did a business valuation for a firm, which was not a big firm. It was worth about $1 million, okay, according to our numbers. But their buy-sell agreement, when we reviewed the buy-sell agreement, we discovered that in the event of a triggering event, and we'll talk more about triggering events in just a moment, but in the event of a triggering event, the business would be valued at book value. So the business is worth $1 million. What do you think the book value was? It was about $100,000. It was about So I asked one of the owners, I said, John, if you were to die and Dan bought the business, he could write your family a check for $50,000. How do you feel about that? How do you think you felt? It's time to revisit this buy-sell agreement. We also asked if the buy-sell agreement was funded, and they said, well, yes, we've got insurance. And in the process of reviewing that, we learned, well, the insurance had lapsed 3 years before, so they didn't have the insurance. So we see a lot of problems here. But multiple owners properly fund buy-sell agreements. By the way, I'm going to talk about this directly. Sole owner businesses also need a buy-sell agreement because they need to plan for what happens if I die or become disabled. And so sole owner businesses can do what we call a one-way buy-sell. Got a slide about it. We'll talk about it. And I highly recommend you take a look at that if you are a sole owner business. You can fund retirement ahead and estimate your nest egg. Ready to sell, you can determine the asking price. And then estate tax, you can fund the burden and also prepare for the burden for your family. This was a business valuation that we actually did. This was a pharmacy company. This was a sole owner business where he owned a dozen pharmacies. These are small, independent, small-town pharmacies. He owned a dozen of those. His business is worth $14.4 million, the equity value. Basically, the equity value is what this owner would receive in cash at the sale of the business. Now, most private company sales are, and this is wrong, it says equity sale value. That should say asset sale value. I got copied wrong. But the asset sale value you can see is about $3 million less That's because in an asset sale, you're selling the assets of the business, not to include liquid assets and not to include debt. So in his case, he had zero debt, and he had about $3 million of cash and receivables that he would have kept. So if he sold in an asset sale, he would actually receive 11.6, but he would get he would keep all the cash. Enterprise value is basically the valuation methodology that's used by institutional buyers like private equity, hedge funds, so not always relevant for us. And then liquidation value, again, is the liquid assets that we mentioned, about $3.4 billion. So this is an actual valuation that we did for this business. I'll just mention briefly, when we do a valuation, there are three parts to our methodology. One part is the market approach, which is looking at other businesses in your industry that have sold in your geographic region. And so it's just like a home appraisal. You're selling your house and you get the comps. We do the same thing for businesses. So the market approach. The second is the income approach, which is taking the earnings of your business and applying a multiple. And the third is rules of thumb. Different types of businesses have different rules of thumb. So we employ all three of these approaches when we do a business valuation. By the way, we don't charge for this. This is a wonderful investment that we make in the relationship with our clients. So we do not charge a fee for our business valuation. Rule number 3, select and prepare the right successor. What are the steps to help prepare a successor? Establish clear guidelines that they will need to take to become the leader. Determine the future leadership needs of the business. Develop a successor development plan. Coordinate the succession plan and successor development with family members and key managers being future non-owners who would like to stay with the business because they are very important to the business. Encourage utilizing a mentor and spend time working outside the business as a successor to learn more about the world. Number 4, put it in writing. What is a buy-sell agreement? A buy-sell agreement is a legally binding agreement that requires one party to sell and another party to buy a particular ownership interest in a business in the event of a triggering event, such as the death or disability of an owner. There's actually 5 Ds, and we'll talk about in just a moment. There are 5 Ds, triggering events, that you should plan for, at least plan for, in a buy-sell agreement. The document often stipulates how much one business owner will pay the other's estate or heirs for their share in the business, the method of valuation that will be used, and please don't use book value, okay? The source of funding for the buyout, who is eligible for payment, and the definition of disability. Very important. We see a big disconnect often in a buy-sell agreement that says that at the total disability of an owner, their shares will be purchased, but the definitions don't match insurance that might be in place. So the definition of disability is a very important feature in a buy-sell agreement. So here are the red flags, and we see these all the time. Number 1, the buy-sell agreement was established incorrectly based on the business entity type. Are you a C corporation? Are you an S corporation? Are you an LLC? If you're an LLC, are you taxed as a C corporation, as an S corporation, as a partnership? What is your business type? There are certain types of buy-sell agreements that just don't fit certain types of businesses, and we see a disconnect there often. Established incorrectly based on the number of business owners. This happens especially when things have changed, where the business was started by 2 partners, and then 10 years down the road, they bring in a 3rd partner, but they never addressed the buy-sell agreement, and it no longer really works. And so it's established incorrectly based on the number of business owners. If it doesn't account for all 5 Ds, so we mentioned death and disability, you should also plan for divorce, departure, or disagreement. So divorce is self-explanatory. Departure is the hoped for retirement of the owner, you hope. And then disagreement would be where you have 2 or more partners who reach some kind of impassable disagreement, and they have to decide, what are we going to do? How are we going to solve this? might be that the buy-sell agreement is triggered. An inconsistent definition of what is considered disabled, again, no proper valuation has been placed on the business. The agreement isn't funded. There's no money there to do it. You've got a buy-sell agreement. How are you going to do it? There's no money to do it. And the agreement isn't signed. I've seen some horror stories where the owners of a business went to the trouble to have a buy-sell agreement drafted and never signed it. So these are the problems we see with buy-sell agreements.
I would be an advocate too. We get a business appraisal every year here, and I really like it for the information that it gives to all of our shareholders in terms of really get a clear understanding of how a third party, what's valuable in an insurance business or a construction business or whatever the case may be. What is driving the value? Even if you're not selling the business in the next couple of years, but it's, you know, it's obviously going to happen at some point. Having your team know sort of what those key metrics are and what a business valuator is going to place value on, I think is extremely informative. We got in a deal recently where one of the principals died unexpectedly, and literally the other two, lieutenants overpaid for the business. I mean, they flat out, because they felt bad, they found out this guy got cancer and died in his early 40s. They found out he had no life insurance in place.
Oh my gosh.
And so they structured a buyout with his widow, and it was all good intentions, but literally the challenge they've had is they've had a hard time growing their business because of this drag, because they essentially valued the business too high.
Yeah.
So
And was it an installment?
it was an installment deal, and I thought it was curious. You mentioned the different terms and all that. Their buyout was structured to be 7 years long, and in their own internal buyout, it's 5 years.
Oh wow.
And I'm like, well, this has been a hard thing to pay off in 7 years, or you've overpaid for it. Probably the latter.
Yeah. Yeah.
But I thought it was curious that they would have a different buyout term for their own deal when it's been a struggle to do this, the initial buyout.
Absolutely. Crazy.
And having realistic, the 59% overvalue doesn't surprise me. A lot of people don't understand that what drives the value, and so they've got an unrealistic expectation of what the business is worth.
Yeah.
The sooner you can get that tethered to reality, the better chance you're going to have to get a realistic program in place.
Thank you. I'm going to touch on one-way buy-sell. Are there any business owners here who are sole owners? Okay, great. We see this very, very often with sole owner businesses where they have not addressed what happens to me if I die or become disabled. And we can include in one of these one-way buy-sell agreements also a structure for a planned buyout, okay? But really, it's more often than not a protection device to make sure if I die or become disabled, there's going to be somebody there to run and continue the business, and my family is going to receive the value of the business. So a one-way buy-sell agreement is uncommon, but I think very desirable. This is where an owner enters a buy-sell agreement funded with life and disability insurance, I believe, with a key employee. And per the buy-sell, the buyout would come using the proceeds from either a life insurance policy or a disability buyout policy, so that the owner's estate can sell the business to the key employee and the owner's family receives money. Pretty straightforward approach, but again, it's very uncommon. We don't find this. We see sole owners who think of the term buy-sell agreement, and they think, well, that's what you need if you have partners, okay? And they typically don't even think that, I should have a buy-sell agreement. But we recommend this for sole owner companies. And do sign the agreement. We want to remind you of that. Rule number 5, review the plan at least every 3 years. Business owners have stale agreements in place leading to underfunded agreements. And the big question is your buy-sell funded, and is it adequately funded? About 16% say no, it's not funded. 27% suggest it is funded with cash flow from the business, which in Doug's example can be burdensome. It can even kill a business. yes, it is funded with disability buyout or life insurance, or yes, it is funded with life. This is what I want to point out. 52% say, if they have a buy-sell agreement, they say it's funded with life insurance. 5% say it's funded with disability. This is another big issue we see all the time. That's planning for the disability. Why is that important? Why is that important?
Because it's more likely you'll be disabled than die.
Thank you, Mr. Actuary. You are 3 times more likely to become disabled during your working lifetime than you are to die. 3 times more likely. Shouldn't you plan for that? Shouldn't you protect that? So disability insurance.
And when you think about it, that's one of the reasons the coverage is expensive.
Yeah,
When you look at it versus life insurance, I mean, that's why it's more expensive.
Mm-hmm. That's exactly right. So what we find is that 43% of buy-sell agreements are not properly funded. So this is our topic, succession planning. A succession plan is a written plan for the day a business owner decides to voluntarily or involuntarily step down from their leadership or ownership role in the business. Remember the golden rules of succession planning. Know all of the options for exiting the business. Am I going to go public? Am I going to do an ESOP? Am I going to sell to an inside buyer? Am I going to gift it to the family? Going to liquidate if I don't plan. So know all of the options for exiting the business. Know the true value of the business. If you've not had a business valuation, if you'd be interested at taking a look at what is this asset worth. You know, for most business owners, their business is the single largest asset, their personal balance sheet, but they don't know what it's worth. Shouldn't you know what it's worth? And that's an area where we'd be happy to speak with you about the process where we could help you determine what is the true value of the business. Select and prepare the right successor. Is it going to be inside management? Is it going to be family? Select and prepare the right successor. Put the plan in writing. And what else? Sign the agreement. Thank you. Sign the agreement. And then review the plan at least every 3 years. Review it from the standpoint of, is the documentation still relevant for us? Is the valuation methodology appropriate for us? Does it address the number of owners we have by name? Review the plan at least every 3 years from a documentation standpoint, but also from a funding standpoint. Is it adequately funded? And if not, let's get it funded so that if something happens, we're prepared. Okay, so this is the presentation. I hope this has been helpful, and we certainly would delight in speaking to any of you who might have further questions. Let me just pause and say, are there any other questions about what we talked about? Okay.
One of the things I would say, there's a lot of construction companies in the room, right? If you do embark on this process, one of the reasons it's near and dear to our hearts, we do a lot of surety bonding. It almost inevitably will have surety bonding impact. And it's funny how sometimes this happens, but, you know, a company may develop a profile in the marketplace and they never have to bond anything. And then all of a sudden, you know, they implement a management buyout program or an ESOP or something, and then boom, you know, they need the largest bond they've ever had. Or they've got to join an SDI program and they've got to disclose all of this. And, you know, an ESOP or any other kind of buyout, typically there's going to be some debt somewhere, you know, generally. And so it's definitely something you should engage your surety people in the conversation relatively early. I mean, you don't want them driving the bus, obviously, but we had a situation recently where we went through an ESOP with a very large account that we've had for a very long time, and they had been with their current surety for 15 years going into this ESOP transaction. And frankly, I felt like it was likely that they would, you know, get their head around it and would accommodate the deal. But as we went through due diligence on it, we determined that that particular company has had a couple of big whopper surety losses that they felt was partly attributable to owners who kind of checked out after an ESOP, whom they did not have personal guarantees from. And so at the end of the day, when we got to the end of the negotiation, they wanted substantial personal guarantees from the people who were taking the checks home from closing, because there was a bank debt component, and then there were seller notes, which is not uncommon in the ESOP. And, you know, the bank money usually comes out at closing, and then, you know, you amortize that off, and then you start the seller notes to amortize. And they basically said, look, anybody taking home checks from the closing, we want X amount of personal guarantee. It was, you know, a lot more than we'd ever given in the last, 20 years, because we hadn't been personally guaranteeing the surety for a long time. And so we literally had to move that program to another surety where we were able to get substantial, they still had to guarantee it, but it was 5X less with the second surety. So that was kind of an eye-opener to me, because I felt like these guys knew us really well, and they would get comfortable with this new capital structure, and they would stay involved. And fortunately, we had other folks that we'd done business with over the years, and they knew us, and they were happy to take that additional risk. But it definitely will change depending on, the details of it, the price, the debt needed, and, how much bank involvement is there. All of those things for surety bonded construction companies, they're going to be relevant to your surety. And you just, you don't want them driving the bus, but you definitely want to be out ahead of those, and so that you can take them into account in negotiations.
That's great.
But this is an area we see a lot of issues with. We would echo a lot of Joe's comments. Fortunately, I think a plus of being bonded contractors is that I would guess that most of you have some kind of program in place, because the bonding company tries to get you to do it because they've got an interest in it, right? And so from our standpoint, our bonded clients tend to have some plans in place, but a lot of times they really don't get a thorough scrutiny from the surety underwriter. They're more concerned about there's some life insurance, and there's a way to transition ownership if somebody dies, but they're not underwriting it for the long-term, effectiveness of it. And some of the issues that Joe pointed out, we see those commonly. Man, if a triggering event happens and you've got the debt terms aren't right, or the price is wrong, or the valuation mechanism's not appropriate, I mean, it can just totally blow up a really good business, and it's all preventable. So we appreciate your interest, and thanks for coming out.
Can I take one more second?
Sure.
I just want to introduce a couple of folks. Michael Kipnis is one of my partners at the Piedmont Group, and Ross White, also one of the partners. Ross has actually done some work with your firm, and you might know his brother, Knox.
Oh, yeah.
So all three of us will be here. If you have any questions, approach any of us. We'll be happy to speak with you about any of these issues. Thank you very much for coming today. It's fun, and I hope it's been helpful to you. And I hope you learned at least one thing you can carry out of here and put into action. So thank you, Doug.
Very good. Thank you. Be on the lookout for our next event. It's a breakfast event, Wednesday, March 27th. We're going to have Phil Beck come back in. He did a program for us in January. It was very well attended, and he sort of ran a little long on his material, and he promised to come back and do part 2. So please come out and attend that if you can. He's really good, and he's got a lot of practical hard won experience in construction claims and what's going on in the legal climate for contractors right now. So thanks very much. I want to thank Katie Amahiba, who put all this together and keeps our trains running on time on this program. She's the one that you got all the emails from, and she's the one that ordered the lunch and did all the name tags. And if we didn't have her running the trains, we would be in sorry shape. So thanks very much, and we'll all be sticking around here if anybody's got any other questions.
Thank you, sir.
Okay, I'll not take that with you. Oh, yeah. Thank you.